guys today, and this was about 3 years ago when I was having these discussions, who believe that interest rates are always going to be at 3 and 4% are freaking morons. Because in 1981, when they went to 17%, nobody could believe it. Well, believe it. It happened. And it's going to happen again. And how can somebody be so dumb to believe that floating debt at 3 or 4% is going to stay that way, and that if the interest rates go against them, that they're going to lose the property to the lender? How could anybody be so naive as to believe that? Well, they're either too young and don't understand what happened before, don't understand history, or they're looking at it from the standpoint of a gambler. There are compulsive gamblers in real estate all over the place, just like there are who are day traders in the stock market. These guys have a gambling mentality. There's something called Gamblers Anonymous. It's for people who lose all their money gambling, who didn't realize or couldn't admit that they were gambling all their money away. Many real estate syndicators and investors belong in Gamblers Anonymous.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Joel Friedland. Joel has been in the industrial real estate world for over 40 years. He buys industrial properties all cash and no mortgage. And in just a minute, we're going to speak with Joel Friedland about syndication of industrial properties in the Chicago area. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Joel Friedland. Welcome to CRE Radio.
Thank you, Darren. It is great to see you.
Well, likewise, I'm delighted to have you, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So I am 64 years old. I live in Chicago. I've always lived here. And at age 22, I went to work for a wealthy family that owned 80 industrial buildings, and they taught me the industrial real estate business. And they were syndicators, and they were fantastic mentors and taught me how to syndicate. So since age 22, I have bought about 100 industrial buildings with hundreds of investors. Usually we get about 40, 50 investors in each deal. We have a very low minimum so that people can go in multiple deals because we don't do funds. Our minimum is $25,000, and our average investor is about $100,000 per deal. And I love the business. I'll tell you all the reasons why I love industrial. And I also want to talk a little bit about insurance, since that's what you do. And I'm currently at the point where my insurance renewal for the $70 million package is coming up in March. And I love my insurance guys, but at some point later, can we talk a little bit about what I ought to do with this thing?
You've got my number. I'm all in on that. So
oh, good.
You bet.
First, let me tell you about our portfolio, because you can't necessarily insure it unless you know everything about it, right? And I think what the insurance company wants to know is what investors want to know. It's exactly the same thing. They want to know what it is, what it's worth, what the physical elements are, what the financial elements are, replacement value. Those are all things that you need to know when you go to your insurance people, and my investors want to know before they send a check. So I think that's really an interesting way to talk together about what you're an expert in and what I'm an expert in. But the thing that I have to tell you is that I don't think anybody else in the United States does all cash, no mortgage deals. I have looked and looked and looked on every podcast, on every Google search. The only person who talks about not having mortgages and not having debt is that Dave Ramsey. And he's
Right.
and
Yeah.
he's talking to a
He's
different
anti-debt.
type.
All yeah. Yeah.
Yeah, he's talking to a different type of person that
Right.
invests in my deal. That's a guy who he's talking about car payments. My
Right.
guys drive cars that they pay cash for generally. If they finance them, it's not because they can't afford it. It's just easier to pay payments, but it's not about, I wonder if I can afford it. So my
Right.
investors are the kind of people who are millionaires and billionaires who really like preservation of capital, which is why they like my deals. But there are people who hate them because without leverage, there's no multiple, there's no exponential return because leverage, if you leverage something 75% on your equity, you make a giant return if it works. But if one thing goes wrong, like what's happening now in the economy with interest rates and with tenants having problems, you can lose all your money easily because there's no cushion when there's a big amount of debt. And I got slammed in two of the last four downturns that I experienced. One was in 1990, and the last one was in 2008. And I woke up from literally being in a total clinical depression both times, trying to figure out how to avoid the depression from ever happening again. And I figured out that all cash deals with no mortgage can't be taken back by a lender because there's no lender.
Yeah. No, that's the aha. And it's funny you say that because I think personally the aha of we have a small portfolio we invest in, but just that recognition of how sexy the low interest rate debt is. But in commercial deals, that's not a forever deal. That's kind of a limited term. And depending on what happens to the rest of the market, especially in your area, if all of a sudden there's new, sexier, shinier deals, and your tenants all of a sudden want to move, or whatever the case may be, your whole financial picture can be turned upside down in a hurry. And I think the message I'm hearing from you, the no debt, is one that I think a lot of people forget when interest rates are so low. But when I first started investing myself, that's all I could see was, if I could get the principal paid off, I'd have an asset free and clear, and unlimited cash flow, or the cash flow would not have any kind of or a very limited cost against it. So tell me, you mentioned the two cycles there that kind of made you rethink your business. Um, in the preservation of capital, have you found in the marketing of this type of a debt structure or a no debt structure, have you found a receptive audience? And if so, can you describe what it is that appeals to them?
Sure. Well, the first thing that I do is I find people who already like the concept. I'm not trying to convince anybody that it's a good idea. I find people who say, "Oh, I really like the idea of no debt." And that's probably one out of every five people. Four out of five think it's ridiculous and stupid. But I'll tell you that in 1981, when I started working for the family, their name was Podolsky, interest rates were 17%. So as I was watching, after I got out of my depression, when I had some really bad financial problems in 2009, 2010, I realized that the way to avoid being in that depression again or losing money. I've had 100 deals. I've lost money on 9 deals, and they were tragically awful. I mean, 5 of them were total losses, 4 were partial losses. And I start with that when I talk to investors. I start with guys today, and this was about 3 years ago when I was having these discussions, who believe that interest rates are always going to be at 3 and 4% are freaking morons. Because in 1981, when they went to 17%, nobody could believe it. Well, believe it. It happened. And it's going to happen again. And how can somebody be so dumb to believe that floating debt at 3 or 4% is going to stay that way, and that if the interest rates go against them, that they're going to lose the property to the lender? How could anybody be so naive as to believe that? Well, they're either too young and don't understand what happened before, don't understand history, or they're looking at it from the standpoint of a gambler. There are compulsive gamblers in real estate all over the place, just like there are who are day traders in the stock market. These guys have a gambling mentality. There's something called Gamblers Anonymous. It's for people who lose all their money gambling, who didn't realize or couldn't admit that they were gambling all their money away. Many real estate syndicators and investors belong in Gamblers Anonymous. So they can sit there and realize that they have all the same character traits, including making crap up, lying, manipulating, convincing themselves of something that's not true, looking for the big hit, being a real big shot, driving a fancy car, having a fancy life. That's all. The gambler's mentality is all those things. And when someone tells you, I'm a deal junkie, it's like, whoa, stay away. You don't want to be an anything junkie. That's not good. Would you invest with someone who says, I'm a drug junkie? No.
No.
So why would you invest with a deal junkie? It's a stupid thing to say. So my deals are for people who understand that we're not gamblers. We just don't want to lose our money. Preservation of capital comes first.
So the I guess the profile of an investor that is more aware of and conscious of, I don't want to lose. Would you say typically older, more seasoned have more to lose? Is that a fair assessment?
Yeah. We're not looking for people who want to get rich in real estate. We're looking for people who are already rich and don't want to lose their money in real estate. It's a whole different mindset.
Got
And
it.
all these guys who buy the courses and they're learning from the gurus who say, you always make money in real estate. That is such crap. You don't always make money in real estate. And by the way, things go wrong. We had the sewers were backing up in one of our buildings yesterday, the sanitary sewer. So you can imagine what was coming up in the front office of a warehouse that we own. And you can imagine that 2 weeks ago, when a truck hit a wall and knocked part of the wall down as it was backing up to the truck docks. By the way, all industrial buildings have truck docks. If it doesn't have a truck dock, it's not really an industrial building. They also have high ceilings. They also have good parking. They usually have mostly warehouse, very little office. So I'll give you some statistics. The Chicago area has 16,000 industrial buildings. It's 1.5 billion square feet. It keeps me very busy because I'm like a collector. I pluck out the ones that I think I can buy for a reasonable price to get a reasonable return. My investors insist on a 7 or 8% starting yield plus upside. And if you want, I'll give you, it's just so from your insurance standpoint, let's bring it all back to that. I'll give you an example of one of our 19 buildings. We bought a building occupied by a company that makes safety products for the welding industry. 60 employees working in the warehouse, working on cut and sew tables. I don't know if you've ever seen a welding operation, but there's a lot of protective clothing and protective materials they have to use to keep the sparks from flying everywhere and starting a fire. But also they have screens. Each welder works in a screened room where they have these framed, they're not walls, they're just dividers with, you can see there's a plastic material. It's either red or blue or green, and it protects the people walking by from looking directly at the flame because it hurts your eyes in some very bad way if you look directly at a flame when someone's welding. So we bought this building for $2.4 million. All in, including reserves, we're in for $2.7 million. The rent is $235,000 a year. The tenant pays It's called a net lease. They pay the insurance, maintenance, and utilities and taxes. So all we do is collect the rent, and we have some expenses, which are about $15,000 a year from the $235,000 of rent. So we get about $220,000 of rent, and based on our $2.7 million all-in cost, that gives the investors an 8% yield. And now multiply that times manufacturers of food, manufacturers of plastics, like, you know, the yogurt cups that you see in the grocery store. Someone makes those. You know, someone makes your microphone. Someone makes the phones on my desk. Everything's made in industrial buildings. Industrial buildings are the backbone of the world economy because that's where everything's made and distributed from. Amazon occupies industrial buildings. So industrial is very, very hot right now because of the internet and because of manufacturing coming back from overseas, because people are afraid that there's a political problem with China right now, and they don't want to risk having all of their products made in China and shipped over on a container ship. They want to make it right here. So industrial's hot. And now let's bring it back to insurance. So if you're going to insure my portfolio of 19 buildings where there's manufacturers, and the total value of my portfolio is 70 million, how long will it take me to get a quote from you? And what do I have to tell you about the buildings for you to be able to go to your insurance market and get me the best deal?
Well, if I have all of the information, basically the building characteristics, year built, square footage, updates. I swear to God, updates are just driving me bananas right now. A lot of the commercial properties are easier to find that, but when was the roof replaced?
Oh.
When, any electrical updates, plumbing, heating, cooling, that kind of fun stuff. List of tenants, rents, and claims history. I would think we'd be able to get our act in order in a matter of days, maybe, and be in front of underwriters. Presuming everything is in order. Industrial, it's not habitational. That's the first bonus. The second bonus is, if they're industrial buildings and they're sprinkled or whatever the controls are, and I guess the list of the tenants would be a
So we have
challenge.
single tenants. Our buildings are primarily 16 of our 19 are single tenant. There's just one tenant in the building. They occupy a whole. So that's a risk. And
Right.
you talk about what the biggest risk is. Biggest risk is vacancy. Vacancy. That's the biggest risk.
Yeah, vacancy is obviously an issue, but the whatever the tenant's doing, if it's a higher risk class, that can be problematic, depending on what they're doing. If you got any, cannabis type stuff, that's a no for a lot of carriers. But to your point, with that information, we can get some interest in a hurry, and should be able to find something that makes sense. The good news is that the area you're in is you're not wildfires, you're not hurricanes, you're not. I don't know that tornadoes necessarily get up to Chicago per se, but
Occasionally.
Your biggest risk probably with that is probably more of just the a freeze, and I presume that just building codes in your area are probably a little bit more stringent and are built for the environments where you probably don't have that kind of stuff. But um, that's kind of that's the recipe. Those are the pieces that I need in order to make something happen.
So here's my concern about my insurance.
Sure.
There are a lot of industrial real estate owners that are much larger than we are. Prologis is a publicly traded company. They own billions and billions and billions of industrial real estate in dollar value. There are other publicly traded companies. There's private companies who do what we do, nothing but industrial. There have to be 100 industrial only players that have more than we have, who I could find on a list probably in one day. So my tenants when they're looking at our buildings, comparing them to other buildings they can move to. If I have a vacancy and we have a broker handling the leasing of one of our properties, the tenant will come in and say, what are the operating costs? And I can tell them what the taxes are. And I can tell them roughly what the utilities were last year if it was vacant, or I can get that number from the prior tenant. The maintenance, we can guess. There's cutting the lawn, and in our world, plowing the snow and fixing the driveway and things like that. But the one that's the wild card is insurance, because they say to me, hey, well, I was looking at a Prologis building and their insurance is costing me 9 cents per square foot. And I say, well, ours is more. Ours is 25 cents per square foot. And they say, well, how can Prologis be at 9 cents and you're at 25 cents? You're dinging us for 16 cents a square foot that really is more rent because you're paying more in insurance. Do they have that much buying power because they're so gigantic that they can get it for 9 cents? Or am I insuring for other things that they're not insuring for and they're charging it in a different way? I mean, I don't even know.
My hunch, without seeing, policy to policy, is that it's probably a combination. Certainly, when you have a bigger spread of risk, Prologis is worldwide, aren't they? I mean,
Worldwide.
yeah. So their spread of risk is going to be far and wide. Whereas if you're basically Chicago oriented, you're not going to get the benefit of things that don't happen in Chicago. That so that's a piece. But then also just the sheer size. I mean, when the deal's large enough, the insurance companies are able to sharpen their pencil and get the rate down based on just the spread of the risk. And it could be also too the deductibles. They may self-insure. It would not surprise me at all if they don't have some sort of a layered program to where they take in-house the first million or whatever that number might be, and then basically are buying excess on top of that. And so it's not really a fair comparison, because you're talking about something that you're literally trying to transfer the risk, and they're probably taking on quite a bit of the risk
So
in
we
some capacity.
we pass through the insurance to the tenant. So in my case, of course, I want them to not. I don't want them to say, "Hey, I don't want your building because your insurance is too high." I've never lost a lease over my insurance being too high, but I know I'm a little bit ashamed of the fact that I can't compete with Prologis or First Industrial on insurance. So it's like, but at the same time, we have very unique buildings that they don't have. We've got smaller buildings that entrepreneurial companies love and that divisions of large companies love because they can have an operation in Chicago in 30,000 feet and freestanding, no shared walls with other tenants who might make noise or smells or fight for the parking in the parking lot or whatever. They love our freestanding buildings. And it's possible that maybe the reason our insurance is so high is because our replacement cost is so high. Because Prologis might have a 600,000 square foot building, and maybe there's a 50,000 foot unit in there. And the cost of rebuilding that is significantly lower than building a 50,000 square foot freestanding building, which is why nobody's building buildings in our category, because they'd be so expensive that it would be cost prohibitive and they couldn't be able to compete to get rents, because a 50,000 square foot replacement is probably $170 a square foot plus land. And a 600,000 square foot replacement is probably $100 plus land. So maybe it's that the replacement cost of our smaller buildings is just so much greater. Could be that.
Yeah, I would have to kind of run the estimates. I mean, your thinking seems fairly sound, um, but the fact of the matter is, whether it's 50,000 or 500,000 or whatever the size is, there there is a cost factor that decreases because you basically just have a lot of open space as opposed to, um, lots of interior finishes. Um,
We don't have that
and
many interior finishes because we believe in industrial. We hate office. And the more office there is in our buildings, the worse they are.
right.
We don't like flex. I know you have a lot of clients who have flex space and what do you call that in your world? There's some people call it different things. It's where there's no truck docks, lots of office, some warehouse in a multi-tenant building.
Yeah.
Um,
Yeah. For insurance, I mean, if it's still fairly industrial. I mean, we basically just go to the replacement cost estimates and, based on what the usage is, we try and match up the
but that,
space. But
I imagine that would be really high to insure relative to my stuff, which has almost no office. So it's just our market. It's who we are. We like a box with almost nothing in it except a little office in the front where they can have their bathrooms, their lunchroom, a couple private offices, and maybe like an open bullpen area for administrative people or accounting people. That's our focus, are those little buildings. Our average size is 25,000 square feet. We have a 106,000 foot building where, by the way, we have a tenant who makes protein bars. He was on Shark Tank in year one. How about
wow,
that?
that's
Yeah.
cool.
And we have a 10,000 foot building with a limousine company. They call themselves Transportation. They're in 700 cities, and he was on Undercover Boss,
All right.
season 6, episode 6. So, we have a wide variety of tenants, but what we want is little tiny office in the front, much bigger section of warehouse, loading dock or loading docks, a lot of parking, and no vacancy.
No, I think you've got an attractive mix because, like you said, most of the buildings that are being built are substantially larger. And for somebody that, mom and pop or just a smaller business that doesn't want all the neighbor complications or challenges, to have a standalone building that they can control, there's a lot of appeal to that.
There's one
And
more thing, by the way.
sure.
Um, we don't sell our buildings on cap rates. So we don't care what cap rates are. There are two things we don't care about that everybody else does. We don't care about interest rates because with no loans, it doesn't matter. And we don't care about cap rates because we don't sell to investors. We resell when we eventually sell a building, which we usually keep long term, by the way. We like to keep them at least 10 years. But we resell when we sell to users, which is like a neighbor who's another manufacturer. So if the welding safety products company moved out of the building on Tripp Street that I was talking about, I would put it on the market with an industrial real estate broker. There's 300 industrial real estate brokers in Chicago, and it's a tight network where we all bring each other deals and we all know each other. And I would put that building on the market for lease or sale. And if the next door neighbor wants it, it sells for a 40% premium roughly to what it would sell for on a cap rate if it was leased, which is counterintuitive, but that's how we make our money. We buy from a family that owns a building that used to own the company inside and doesn't own the company anymore. They sold it to a private equity. Grandpa started the company, the kids inherited it. Now the grandkids inherited it. Everybody hates each other. Let's get rid of the building. Let's get it out of the family. So we buy the buildings that are occupied by the companies that they used to own that are now owned by someone giant. And then when those people leave, we sell to the next door neighbor for a premium. That's our model.
That's interesting. So the appeal to the next door neighbor, is it basically expansion?
Yeah, almost always. So let's say that the next door neighbor manufactures parts for airplanes. And let's say that they occupy 60,000 square feet where they have 150 employees, maybe 5,000 foot office in the front, and the rest of the 55,000 square feet is production floor and warehouse. And maybe they've got 5 or 6 docks. They have all these machines and all these people. It's hard to find good trained labor. Once you train people, you don't want to lose them. And let's say they need to expand. They get a big, let's the Boeing sends them some kind of a request for proposal, and they get the job, and now they have to make parts for wings for the airplanes that they weren't making before. They don't want to grow by moving the 60,000 feet into 90,000 feet because it would cost them 20 million to move.
Right.
They want to buy the building next door so they can own both and then connect them with a hallway. Of the 16,000 buildings in the Chicago area, 600 of them are connected by hallways where the neighbor needed to expand and the building next door came on the market. We had one case where the seller, an investor of mine, and I didn't own that one. He owned it and I was advising him. Next door neighbor needed the building and we asked for $4 million. And if he had leased it and sold it on a cap rate, he would have gotten 2.5 million. And the neighbor said, no, I'm not paying you 4 million. And about 7 months, 8 months later, after fighting us every day, he paid 4 million. Had to have it. Tool for his building was a tool for his business. It was not a real estate investment.
Right. No, and like you said, the alternative is to pick up and move, and that's not
Not an
an
option.
easy, yeah, for something that large and with a footprint and yeah, the logistics make a lot more sense to buy the neighbor.
By the neighbor. So
Yeah.
our whole plan is buy from a family that doesn't want to be with each other anymore. And then eventually, after collecting 8-9% yield, sell it to the neighbor, make a profit. And then we try to hit 14% IRRs on these things after selling. And if we do sell it to a neighbor, it could be 18 or 20% IRRs. You have to get lucky. The neighbor has to want it when you're selling, but it can be the neighbors across the street or the ones on either side or the one behind, or it can be someone just 2 blocks away who just wants to be closer than the next town over.
So let me ask you, when you're identifying these properties, you've identified kind of the prospective seller in that there's a business in or a business that owned the property that no longer wants to own the property. So that's step one. But on your underwriting and kind of your due diligence, are you also paying attention to the neighbors then?
Yeah, I personally, so we have an organization that was built on being in the industrial brokerage business. And the industrial brokerage business is built on cold calling, mostly on the phone. But my first day in the business, my boss, Milt Podolsky, told me to go canvassing door to door in an industrial park where he had a vacancy. And he said, go in that industrial park. I have a 30,000 foot vacancy there. Go talk to all the neighbors and grab me a tenant from the neighborhood, which I did. So I learned that if you go door to door to find opportunities in industrial parks, very few people do it. So you get right in. Even though the window on the door says no soliciting, I couldn't care less about that sign. It doesn't scare me. So I've taught my son and my partners and my mentees how to go door to door. So when we're buying a building, the first thing we do of due diligence is we talk to the 100 closest neighbors door to door in person. Sometimes we have a buyer lined up for a flip. It's like wholesaling before we buy it. We bought a building for $700,000 a number of years ago. And the seller showed us his appraisal that said 700,000. He says, you got to pay the appraisal price, which we did. We sold it the same day that we bought it for $1.3 million to a neighbor 3 doors down. How did we know? We walked around.
Yeah. One of my clients has always made me aware that real estate's a belly to belly business. I mean, that's really where you can. Well, it's just it makes a lot of sense because it's especially in this day and age. You bring up a great point where so much of the communication is done, by not talking. The fact that we can see each other right now and hear each other is kind of the I don't know. It's nice, but it doesn't replace the in person kind of thing. Um, and but I think I get so annoyed by how many ways we have to communicate, and rarely do people you know actually engage. It's everybody wants to text or email or on my time kind of thing. It's like, man, I need to see you and talk to you to get,
That's why this is good.
yeah, yeah,
The visual, it's great.
yeah. No, it's served a great purpose. And I think a lot of us had some Zoom fatigue during the COVID, but it's nice now as a tool as
Yeah.
opposed to the only option.
Yeah.
Um, so the basic strategy is to find uh, industrial properties where there's a wanting seller, and then the exit strategy is to find a willing wanting buyer, preferably a neighbor. Is there any, commercial real estate, kind of where you basically have a lease, uh, if it's got renewals built in with increases, is there anything else that you guys are able to do, or is it basically just that simple that you find you're able to buy it at a price based on the lease terms, you're able to, achieve a return, and then, hopefully an exit with some bonus?
It, Darren, it's that simple.
Okay.
When we put out a private placement memorandum, the financial analysis portion, which many people have dozens of pages of different scenarios, ours is half a page. It's here's the rent for 10 years. Here are the expenses. This is what's left. This is what gets distributed. And here's our projected sale price in 10 years. And here's what your return will be as an average annual return over the 10-year period if we sell it for this price and you collect this much cash flow in rent. And it's that simple. And people look at it and they say, whoa, I've never seen anything this simple. Well, take the lender out and take the risk out of all of the potential problems with rates going up and down and having to pay down debt at certain times in the economy. Banks sometimes make you pay down debt because they're uncomfortable with the loan to value ratio. None of that comes into play. It's a really simple model for us. The hard part is finding the deals to buy. And that's where the art is. The art is finding those deals. And that's relationship building 101. Find the family that owns the building, get to know them, tell them you're there to help them in case they want to get rid of it. And they call you back and say, okay, how much?
Yeah, kind of like a farmer, you keep nurturing the field there, and eventually have a crop. That's good.
I'm a farmer. I'm a
Okay.
industrial real estate farmer.
I
Yep.
got it. I get it. Hey, Joel, if we could, I'd like to shift gears here for a second.
Sure.
As I mentioned, by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there are three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. That's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be your investors, the tenants, the market, political, however you choose to identify what you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Joel Friedland, what is the biggest risk?
I'm afraid I can't give you just one because there are actually multiple risks. I've been doing this for 40 years and I can tell you exactly what I struggle with risk. Number one risk, debt. If you have debt and anything goes wrong, you are screwed. So that's why we do our deals debt free, no mortgage. That's number one. Number two, in industrial, vacancy. When a building's vacant and it's a single tenant building on a net lease, when the tenant leaves, it's either 100% vacant or it's 100% leased. So vacancy, vacancy, vacancy. It hurts us so badly. We need to keep our buildings occupied. The third one is your area, which is risks that have to do with losses. Trucks hitting the side wall of a building, which happened to us 2 weeks ago. Flooding, roofs that a tree falls on, all those kind of insurable risks. Those are really big for us. So basically, it's almost as if we are a homeowner and we have all the same issues as a homeowner, except we have a tenant that pays rent instead of us occupying the house. And that's the fourth risk. If you do a deal with a tenant with bad credit, collections.
Yeah, no, that's all those can be a nightmare, and but when they work, when it works, it works, and so makes it work. Hey, Joel, where can the listeners go if they'd like to learn more or connect with you?
We are at britproperties.com, BRIT with one T, properties.com.
Got it. Well, Joel Friedland, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thanks, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.